Welcome everyone to episode 206 of the Trust the Plan podcast. I'm Nick Hopwood.
And I'm Jim Pilat.
And we're excited to have you here. We got a great episode in store for you. But first, got a couple weeks till Christmas.
Yeah.
Any big plans coming up?
Just got to get going on the Christmas shopping. Feeling a little behind, but it'll get there. How about you?
Well, like last week, we talked about the CFO and COO.
Yeah.
COO is in charge of Christmas.
Nice.
So I don't have to do too much.
Okay.
I'm not good at it either. I'm just,
No.
It's one of my weak points.
Yeah. It's not a strength of mine either.
I think this year for the office, we're going to do a little white elephant action.
Ah, there you go. Mix it up.
That's right.
Should be fun.
Remember the episode in the office when they did the gift exchange? And they're supposed to buy a gift for $25 or less.
Uh-huh.
And then, of course, Michael throws in an iPod, which is worth $200.
Yeah.
So everyone, whenever it's your turn, just give me the iPod.
Yeah.
And it was
they kept stealing it.
Yeah. Of course, that's what you're going to do, right?
Right.
So we'll see what happens. We'll report back in a few weeks on the gift exchange here. I know you're excited for it.
Definitely.
So this week, what are we talking about?
And this week's about a Ramsey article. Our good friend Dave Ramsey is always putting out a lot of information, but he put out one recently that talked about how he thinks people that use a 4% withdrawal rate are crazy. They need to he can go all the way up to 8% withdrawal rate and be okay.
Are you picking on Dave again?
I just don't know that I like Dave. I like a lot of what Dave says, honestly, but sometimes he takes certain things and pushes a little too far, I think.
Yeah, I agree. I think that in terms of budgeting and getting out of debt, there's nobody better.
Yeah, does a great job.
The math, the motivation, very, very good from Dave.
Yeah,
very
inspiring
important.
people to get on track and do the right thing.
Yeah, and the whole church network of having education across the country. Great job.
Definitely.
But this is out of the park crazy, in my opinion.
Yeah, I didn't. That's it jumped on my radar as being that too.
Yeah. So here's why. Okay. He says, hey, if the market makes 12%, which is long-term averages with dividends and everything, then why can't you take out 8?
Right.
Why should you only take 4? Okay, at face value, okay, but who has all their money invested in the S&P 500?
Yeah, it's a really aggressive portfolio.
Yeah, it is.
And most people, when they're at the point of needing money out of retirement accounts, don't feel like being aggressive.
That's exactly the point. So if you talk to people about risk, when they're younger, they might be comfortable having the money all in stocks. But when they're retirement age, it's a stretch to say I want to be 100% equity. I would just never see it ever.
Yeah, I wouldn't say that at all. I said people all the time who are approaching retirement age, and I'm talking 10 years out, are already saying, when should we get more conservative? The thought, it changes your thought of money when you leave the accumulation phase and enter the distribution phase. When you need to start living on it, it feels a lot different when you see it go down.
I mean, also, right, Dave is just on the radio, right? And he talks to people, but he's not a financial advisor.
Right.
Right? I mean, that's all there is to it.
Right.
He doesn't see the stuff that we see. And like him as an individual, right? I don't know, is he a billionaire? I don't know. He's really rich.
Yeah.
He has a lot of money.
Right.
He doesn't have to worry about it.
Right.
Right? He has the great story of going from rags to riches to rags to riches twice. Right? And that's the story that I think that we should lean on him for.
Yeah.
But not the withdrawal advice. Because let's talk about this for a minute, okay? Yes, the S&P the last 10 years has made 12% on average, but nothing else has. Nothing.
Right.
Okay. So if we look at the All Country World Index, which again is 100% stock, that 10-year number is 7.6% per year.
Okay. So you're including internationals, emerging markets, plus small caps and mid caps and so on.
Yeah, that's right. So way less. And then we have the U.S. Aggregate Bond Index, which has made 1.2% per year for 10 years.
Yeah, and that's the part of the portfolio that when people want to be safe, that's typically where they go is bonds, right?
Yeah.
So if you're bond sleeve, which we already mentioned people want in their portfolio when they get older, is only giving you 1 point.
They just want less risk, right?
Yeah.
And that's the natural place to go. and this 1.2 looks nasty, right?
Mm-hmm.
And if you rewind 3 years, it was better, but still not, probably, like, I'm just going to guess here and say it was a couple percent better, maybe say 3%.
Yeah.
Whereas now it's 1.2. That's because the last 3 years, 21, 22, 23, the 3-year rolling number is minus 5% per year. In other words, we've lost 15% or so in the last 3 years in the aggregate bond index. That means your income is coming in and the price is going down. So if you were 100% conservative, we'll say conservative non-bank, but owning bonds, not only are you taking out your 8%, but you're losing 5% on as well. Now, if you start with $1 million, you have 550,000 left. Is that right?
Yeah.
Is that right? No, maybe 650. 15% plus 24. No, you have 600,000 left, basically. So that's a really bad outcome. Okay. Yeah. And so I think if you push Dave, though, he'd say, well, no, if you're going to be 100% in bonds, you can't take 8%. And I think that he would be reasonable. But then he would say, but you need to have stocks.
Yeah.
Right?
He would try to convince you.
Yeah. And that's okay, too. You can have a conversation about how much risk you want to take. But here's the balanced index over the last 10 years. And that is a 5.4% trailing 10-year return, right? The stocks are above that, and the bonds are way below, and that's the balanced index. I feel like the next 10 years, fixed income should do much better.
Yeah, I would think that we're well positioned to see better fixed income returns.
Full disclosure, compliance, regulations, et cetera, should do better than 1.2% per year. And the reason why we can say that is current yields, for a lot of these bond funds and bond indexes are around 5%. Some more, some less. And so when we think forward 5 or 10 years, generally speaking, the current yield is your 5-year, 10-year total return.
Right.
So that's exciting, right? But again, if you are 100% conservative in bonds, you shouldn't think that you can take out 8%, right? Maybe you can take out the dividend, right?
Right. Yeah, I think the other thing with it, even if you are aggressive and you want to be all stock, right? It doesn't, you have to acknowledge the sequence of returns as well.
Yes.
Meaning, we have a year like we did in 2022 where stocks were down 20%. And then you go ahead and yank 8% out of that. You just took 8% off a much smaller number. It makes it really hard to start recovering from that.
Yeah, that math, minus 20, then minus 8. So you have 720,000 left after that year, and you started with $1 million.
Right.
Then you take 8% off a smaller number, right? That's what, like 57,000. Okay. And who knows what that return is? Okay. If it's nothing, okay, then now you're at like 670,000. Okay, you start to get a little nervous.
So you've lost, 33% of your portfolio in 2 years' time.
But maybe, okay, so that takes you down to 670,000, and then maybe the market does make 20% the next year, right? It goes down 20, then up 20. That's reasonable, right? Well, because the withdrawals, right? You're making 20% on 670. That's like 10% is 67. I'm doing math live here on the podcast. So you earn 134,000 on your 670, which means that you have about 700,000 left. No, that's 800,000. Remind me not to do math on the podcast anymore.
Tee up our math equations.
Yeah, where's my calculator? So you're still, right, you go down 20, up 20. First of all, it's not the same, right?
Yeah.
And you're making your 8% withdrawals. You're still down 200,000. Dave, help me.
Yeah. Yeah, it's not a good situation, and that's the first thing I thought about. That is people who use a more generous withdrawal rate. They don't account for bad years. They think every year you're going to consistently get this much, and if you did, well, then that's great. Then it does work. But
you don't.
You don't. And that's the only thing we know from history, right? Is that you're not going to get the same consistent return every year.
That's right. So if you are thinking about retirement, or you're retired and you are thinking about how much income is safe to generate from your portfolio, right? We're retirement income experts. We're both CFPs. We have Preston as a CFP sitting back over there watching. We have a whole team where we can help analyze your situation and see, if it makes sense for you to retire or keep working, or, whatever we have to do to reach your goals. So that will do it for episode 206, talking about Dave Ramsey withdrawal rates.